Multiple is basically when you're buying businesses, in most cases, you'll buy them as a multiple of the earnings or the profit of the company. The fancy word to go for that a lot of times is the EBITDA, earnings before interest, taxes, depreciation, and amortization. But the easiest way to think about it is really just how much cash flow does the business generate. And most businesses are valued or purchased off of a multiplier of that. So we can unpack in detail multiples and how to think about them and all this other stuff. But before we do, I think it's a really cool just illustration to say, hey, all right, if we have this little company, right, let's buy a business. In this case, it's a third of the size of ours, which is, it's exactly what we were talking about. This other agency that's doing $1 million of revenue, it's a little smaller, so they're not quite as efficient, right? So they're only operating a 20% margin. They're making about $200K a year. And this is something you'll see across industries. You'll see in the agency and the e-com brand world. The smaller a company is, the lower its multiple is. Conversely, the bigger a company is, the larger its multiple is. And so companies that are doing $5 million or $10 million a year of earnings will start to get into high single digit or even low double digit earnings multiples, which can really stack up to be huge valuations for these companies. But because this business is smaller, its multiple's a little bit lower. So in this case, I think a 3 times multiple is a pretty reasonable valuation for a company of this size. And so 200K of earnings times a 3x multiple is about a 600K valuation, right? So great. We found a single deal. It's about a third the size of our company. Let's buy it and see what happens.